What happens if you invested a specific amount every single day compared with lump sum investing? This is a common question people ask me, and the answer isn't so straightforward. You have to take into consideration time, the amount of money invested, what price you got into a specific asset class, and if you're new to investing, or even if you're on your investing journey, this can still be quite overwhelming, especially if you're looking to invest every month, or if you're not too sure whether to invest every single day. But I wanted to test it so you guys don't have to. So what if you were to invest £10 for a month every single day, compared with holding your assets you invested in for 2 months, for example? Now, before we begin, we have to choose a vehicle, an ETF, to carry us through this challenge. And what not better asset class to choose than the ETF FTSE 100 here in the UK? I mean, we've got to show the UK some love, right? With that said, for those of you who are new here, my name's Kai, and I've been investing consistently for just under 2 years now, and I've documented the whole process on this channel. And I've grown my portfolio from £1,500 to 40k in that period, making some good decisions, some bad ones, all shared on the channel for you guys to see. Now, for reference, the FTSE 100 fund size is only £14 billion when you're comparing it to the US, which is over 130 billion in fund size, which is completely insane when you think about it like that. So when you're looking at these two ecosystems, they are really worlds apart. Now, that context is important because for those of you that don't know, most of my investments are made in the US, so I have a lot of exposure to the S&P 500, as well as some individual stocks such as Google, Microsoft and Amazon. The S&P 500 consistently dominates its peers such as the UK, and there is a few different reasons for that. But before we dive in, looking at the FTSE 100, there is a few reasons why you could say it's more of a slower growth market. For example, the first point is sector mix. The FTSE 100 is dominated by banks, energy companies, commodities and general consumer goods, whereas the US has a lot of fast growing, well-funded tech companies, which has been the key driver for decades when you're looking at markets and overall investor sentiment. Furthermore, the US mega caps, so the Magnificent Seven, companies like Google, Nvidia, Microsoft, these companies quite literally trump economies, right? A lot of these companies are bigger than some economies. So when you compare them to companies sitting in the FTSE 100, there is no real comparison there, as these US companies are generally hyper growth leaders in their fields. There's also a difference between dividends and growth. For example, if you're looking to invest in companies that are producing steady cash flows that will pay you a dividend quarterly or semi-annually, there are a lot of companies in the UK that can do that, right? But they're not going to grow as quickly as companies based out in the US, because companies based out in the US will raise a lot of money, they'll IPO, a lot of companies will IPO on the US exchange, and these companies will make more revenues compared to companies based out in the UK and other European entities as well. So overall, if you're looking at high growth and scalability, you're going to look towards the US, compared to if you're looking for consistency and a steady paying dividend, you'd look at companies based out in the UK on the FTSE 100, for example. Now, as you can see, we bought one share every single day at around 8:30 on the FTSE 100, and the average price was about £9 per share, and we've done this consistently throughout the month of September. Now, Lightyear doesn't allow for this specific ETF, fractional shares, so we just bought it spot at the market every day automatically. Again, we wanted to keep consistent and buy the share throughout September, because September can be a slower month throughout the year, typically speaking, when looking at markets, with our last share purchased at the end of the month on the 30th. Now, just looking at some of the price action here, we can see from when we started on the 1st of September to around 20 days to 30 days later, nothing really happened for this month. And like I said, September is typically a slow month when it comes to investing, so nothing really unusual to see there. It was really planting seeds, if anything, to set ourselves up for the next 2 months, and that's typically what happened, right? Start of October, we did see a slight rally. We did grow just under 2%, and this was mainly fueled by the shutdown in the US and investors were looking at other places to deploy their capital, and obviously one of those places was the UK. So that was a record-breaking day for the UK in terms of gains, which was fueled a lot by healthcare companies as well. We then had a slight correction before rallying again, and October was typically where we saw most of our gains, as you guys can see. And then in November we peaked at around 7%, which was great. And now we've obviously had a slight decline in price. Again, a lot of volatility happening now. We've seen things like crypto sell off, but that's another topic for another video. But overall, we did see really nice gains in November, so that's why it's important to hold your positions out throughout these periods. Now, considering we only bought 1 share a day, which was on average around £9, the gains were pretty decent, and it's not easy to psychologically buy something every single day and not trade it. So from this whole challenge here, investing every day, you will see a lot of volatility in markets, and if you haven't automated the process, it can be quite taxing, and you could just fall into the loop of just trading the asset class without even knowing. So for me, I prefer to dollar cost average every single month and keep it super simple like that, as it can be quite taxing, and with the fees on top of that, it can add up as well, even though the fees are very, very minimal investing in something like the FTSE. But overall, we can see that we started just under £220, invested every single day. We did have a slight correction here, but October is where we really saw that growth given the US shutdown, and we landed at, well, our peak was £236, as you can see here, before having a very slight pullback. And that pullback has happened across all different markets, different asset classes as well. So we could see this bounce back by the end of next year, but it's good that we held off, because again, if we had just kept it in September, we would have just been break even, just given how slow September typically is on an average basis. But overall, the goal here was to see how consistent daily investments would perform over time domestically here in the UK. And as we can see, it can be a hell of a journey if you're doing this every single day, right? Compared with lump sum investing, when you let it marinate, you're better off psychologically and you can make more informed decisions. But it was definitely interesting to do this, especially in the UK, given how the US just trump the whole, UK markets when you're looking at it on a fund side perspective. But that is it for the video, guys. If you did enjoy it, please give me a like and let me know what you'd like to see in the following videos. See you on the next one.